This week, I thought we could take a little bit of a different spin on things. We have been these last few weeks, if not the last month or so, really been diving into a lot of the primary drivers and what's moving the market. Now, for two reasons, I think it's a pretty important time to be doing this. Number one, it can just be helpful to zoom out, take a bit more of a 30,000 foot approach on how things are looking. And number two, we are approaching a bit of a crossroad with a few macro factors that I won't dive into today. Let's take a look at what are some of the technical indicators that describe the way that the market has moved in the past? How are they looking right now? Let's look at how some of the different fundamentals have shifted. And what are new drivers in the market that didn't exist? And, what direction are they moving? As well as just having a look at some of the more historic trends that we've pointed to understand when things are looking overheated, really. And I just want to caveat this all with the obvious by now. Hopefully everyone understands that when we look at this sort of stuff, it's not prescriptive on what's to come next. But what we're trying to do at any given time is try to look at data in isolation, but understand how can we blend the story of what's happening in the markets to where we are right now. And that's where I want to start, with the markets being a little bit dull and a little bit lifeless. Let's dive right into some classic technical analysis to start off with. Now, a lot of people may not know about the pi cycle top indicator. It was very, very popular in the previous cycles. And it really made its call to fame because, as you can probably see from, what might look like quite a busy graphic here, if you simply look at these four red dots here, it's to a T basically isolated when key market tops have occurred in the past. Now, what is this indicator? Is it something magical? Is it a crystal ball? No, it's simply a moving average. So it's taking a group of data over a period of time and it's averaging it. That's really all it's doing. Now you've got a fast and a slow. So basically all that's happening there is 111 days. And the second one is 350 days times 2. And really all it does is it provides that sort of lead and lag metric on how price is moving. And what's been found through this modeling is in the past is when this 111-day moving average crosses with the longer moving average, it tends to be periods where the market's overheated. Now, again, this isn't prescriptive on what's to happen in the future, but if we look back in the past, this was really, really popular. And it's still to this day, a lot of people do obviously check in quite a bit with metrics like this. Now, if we are going to subscribe to the methodology of something like the pi cycle top indicator, what it's telling us, we're still very much at this lower end of the spectrum, looking specifically at that 111-day moving average, that shorter moving one. And we haven't even seen a crossover. We still have quite a bit of spread left between these two lines. If we sort of look back into the past, when we have seen these sort of distances between the two lines, it can still take weeks, if not months, before we see that crossover event. But we can also see, if you look back even just the last cycle, it can happen quite quickly. So again, understanding where we are from a technical factor, where are we in this market cycle, it is suggesting to that there may be more room to the upside. Now, when we talk about technical indicators and price moving as an average, we also want to understand what's the market structure? What's fundamentally changed in the market that may also be there to support price as we come back into these, you could call them key support areas. And that's where we can look at the massive new wave of adoption that we're seeing through ETFs and even now treasury companies in the US, where whole companies are being converted basically into crypto allocation funds where people can get exposure. Seeing this is a massive driver for demand so far in the market as well. To the fact that even if we look at since October, really, net asset value aggregated across all these crypto treasury companies has only really gone up and to the right during that period where we did see the tariff war come in, global trepidation on markets in general. We did see this stagger a little bit, but we have only seen, again, resumed strength in this trend. So in my eyes, if we look at understanding where we are from a technical basis, we understand what are key drivers in this market cycle that's different. We are seeing a new structural bid. We're seeing this corporate bid where you could argue there may be durability and persistence. And that's the one thing everyone's keenly looking to understand this cycle. Everyone keeps talking about super cycles, is the durability factor. If these corporates are coming in, are they here to stay? Or are they simply here to run the course of the 4-year cycle? So that's a pretty cool fact. And, these sums, when you add them up, it can get quite staggering. If we look at some of the data according to Bitcoin treasuries, it's 6.3 trillion AUD that's being held just in Bitcoin alone. So again, can't stress enough, this whole market structure shift, it's big for the market, right? Now, another thing that we can look at historically, which has been, quite popular and still to this day, maybe showing that things aren't really overheated, is Google search trend data. So what we're looking at here is Google Analytic data on the current trend search rate of Bitcoin. And we can see that in the blue line, and in the black line, we can see a price. Now, the idea here is that when people are obviously too late to Bitcoin markets in the past, it's been during periods of peak interest. That has just been the unfortunate reality of it in the past. And when we look at some of these trends, we can see the biggest peak we saw was around November 2024. So just leading into the end of 2024, where we did see the markets really start to ramp up, heat up. We saw President Trump get elected, who was very pro-crypto. And we saw Bitcoin really start to fly with, I think it was a 30% move within only a couple of weeks. So again, when we sort of use that as a bit of a reference point, yes, we have made new all-time highs. Yes, price is still higher than when we're at last year, but we're still seeing that Google trend data, or that, that interest level in Bitcoin as an asset. When we look at Google search trends, it's still somewhat in those sort of, again, those range lows. So again, if we're trying to understand, we've got this technical indicator sort of suggesting that we may still have room to move to the upside. We're seeing that structural bid come in from treasuries in a way that we haven't seen before. And we're also seeing that potentially retail really isn't participating in a huge way. It does set the scene for us to understand that, okay, well, maybe there is still a little bit of room to move in this market. But the key callouts from me is obviously there is still a little bit quite different this year to previous years. We've seen politics really come into the asset space and cause a bit of havoc and grief. Take this all with a grain of salt, really. But again, it is helpful to blend a lot of these technicals and fundamental factors to really sort of paint the picture that if things don't change too drastically, there may still be room in the tank for higher. That's it from me here today at Swyftx, and I'll catch you guys next time. Thank you.